If you've been staring at trading charts for hours and still can't figure out why you're losing money, you are not alone. When I first started trading over 5 years ago, I spent days trying to crack the code and just getting it completely wrong. And after coaching dozens of traders, I realized there's one big mistake most traders make when reading chart patterns, and it's not what you think. So in this video, I will show you the number one mistake traders make when reading trading charts, how to spot patterns the right way, and real examples from my own trades that you can copy. Now imagine you want to cook a really good meal. You scour blogs for the perfect recipe, gather all the ingredients, and nail the meal. It's really good. Now, is the next logical step for you to open a restaurant? Of course not, but that's how many new traders approach chart patterns. Back in late 2020, it felt like literally anybody could trade. The panic sell was over, stimulus checks were flying, and trading apps were exploding. And all the gurus on TikTok were just saying, buy the dip. And you know what? They were right. It worked because the market only had one direction to go, and that's up. And when the market feels easy, many new traders mistake luck for skill. But when the market eventually shifted, a lot of those same traders gave back their gains just as quickly as they made them. And I get it. When I first started, I was obsessed with every new pattern I learned. Head and shoulders, triangles, diamonds, pennants, flags, I thought I saw them everywhere. And each new tool I learned felt like I had found a magic key. But the truth is, I wasn't mastering any of these techniques. I was forcing them, and the market punished me fast. There's a name for this stage. It's called the peak of Mount Stupid. It's when your confidence skyrockets way above your actual skill level. It's a place I've spent a lot of time. But the Stoics said it best. You can't learn what you think you already know. And that's the trap I fell into. It's holding a lot of new traders back right now. So if you've been struggling reading chart patterns, it's not that you're dumb, you're not unlucky, and you're not destined to fail. It's that you're probably stuck in the exact same stage I was, thinking maybe you've cracked the code when really you've just scratched the surface. The number one mistake traders make when reading chart patterns is mistaking familiarity with mastery. So how do you spot patterns the right way? Well, it's not one new tool. It's about confirmation. So not one chart, not one setup or one indicator. Real mastery comes from confirmation. And the best example of that, well, it's World War II. Now stick with me. The D-Day invasion was wholly dependent on one thing, and that was predicting the weather. And Eisenhower didn't rely on just one single forecast to make the call. He had 3 independent weather teams looking at the same data, but giving different predictions. And only when all 3 of these teams were saying the same thing at the same time did he launch the invasion. And of course, the rest is history. So trade like Eisenhower predicted the weather. Don't rely on just one thing. Build a team. And for me, well, that's 5 to 6 charts. At any given time, I have a tick chart, a 60-minute chart, a daily, weekly, and monthly chart, and a VIX chart for when I trade the S&P futures. And they're all reading the same data, but they don't always agree. It's my job to sit back and wait until they do. But it's not enough to gather data, you need to interpret it. So now let me take you inside my charts to show you how I use them to spot patterns that actually matter. So how do we tell what chart patterns are valid and how do we use them as traders? Well, I'm going to show you an example of that right now in the British pound futures. It's the 6B. And this is to show you how markets are fractal, which means the same chart patterns play out across all time frames. So here we have our 6B daily chart. This is the British pound futures. And you can see that I've drawn out a bottom head and shoulders. Head and shoulders is a reversal technique. This chart pattern would basically say we're going to trade in the opposite direction of which the market brought us to. This market came down to form this head and shoulders at the very bottom. And if it's a valid pattern, we're going to want to trade back up, a reversal, okay? So in order to do that, we need a few things to happen. And one, the pattern itself is 2 shoulders on either side and then a head in between. So the low is what we call the head, and then the pivots on either side are the shoulders. Then we take this line and connect our neckline. And our neckline is the pivots that formed the 2 shoulders on the upside of this. So if one wanted to trade this pattern, you just have to wait until price crosses that neckline, and it does so here. So this is your signal that maybe you want to buy. And in order to measure your price objective, meaning where do you want to trade to, you just measure out from the head to the neckline, and then you just trade equidistant above. And you can see that this works out beautifully, and price finds some resistance right at where our price objective would have been. It's great. Couldn't draw up a more beautiful head and shoulders to show you. And look what happens next. Price moves to the upside and puts in the exact same pattern, but to the downside. Now this thing doesn't look quite as clean, but one could still see this as a head and shoulders and decide to get short. It worked before, why wouldn't it work now? One very important reason why one of these is valid and the other is not, and that is supporting context from other charts. Remember, we need our teams to all be saying the same thing at the same time. And if we look at our weekly and monthly charts, we see that we are already involved in a much larger bottom head and shoulders pattern. You can see that based on this measurement here, price has not yet gone to equidistant above that neckline. We see this potential head and shoulders up here, but there's no supporting context in the weekly. In fact, that weekly supports this trade earlier, might even go further because we have not yet hit our price objective. Now, if we go to an even larger time frame, the monthly, look what we have here. This is a head and shoulders pattern in its infancy. It's barely gotten started, and our price objective is way up here. So getting short for any long period of time right now would be advocated against, in my opinion, because we have supporting context from the monthly and the weekly that the bottom shoulder we saw here was super valid and will continue to go higher. Here's an example of a chart pattern that formed in the midst of a lot of noise in the market. This is something called the Scleroux box. Arthur Scleroux. This is one of his techniques. First of all, we see that we have some support right here. This is a very obvious range where price has got support and resistance on either side, and a lot of people might be looking for a breakout, but you can see what happens here. Price comes down, breaks out, and comes right back in. The Scleroux box principle is that whatever happens below, in this case, will then happen above. So because price dipped and then came back inside of a range, we can expect the same size breakout above before it comes back down inside the range. So there are a couple things you can do here. Once price comes back within this box there, you could try to get long. The other is that if we expect price to move the same amount above this box as it did below, once it gets there, which look at that, it does, and it's almost perfect. If we were to measure this here, I mean, it's almost the exact same, give or take, right? Then you can trade back down into it because that's what happened earlier, right? So it's like symmetry in the market. And so there's a trade here that one could take. There's a trade here that one could take. And based on this principle, if we expect price to come down after moving the same amount above the box, one could have tried to get short up here because we think price will then come back down inside this box. So this is a really good technique that I use all the time. I trade this more often than any other trade. When price comes out of a range, I expect it to go back inside more often than I expected to break out. So this is an oil chart, a 60-minute chart. I'm going to show you how to exploit expected resistance for a stop hunt trade that follows. The idea behind this is because we've had 3 hits on this line that there are stops built above this thing. This happens all the time. It's a trade I love to take, and that's exactly what happens here. You can see the price comes up and then moves right back inside that range. Outside of the chart pattern itself, we have supporting context down here in our volume bars, okay? Now the red bars denote down bars or bars that close lower than they opened, and the green bars denote up bars or bars that closed higher than they opened. And you can tell that the tallest bars on this chart mostly are the red ones, right around. See how tall these are in comparison to the green ones, which are mostly outliers. We have 1, 2, and 3 taller green bars here, but that's within a clump of larger red bars, and we never get a second large green bar, no follow through. And so when I see this poke above here, see this? I've got 1 green bar here for this poke above. That's the bar that moves us above that line to take out these stops. But the next bar is not big. We don't get follow through. So there's not enough volume support to bring price further up. So a short makes a lot of sense here. And you can see that the volume supports that later on. As the price moves down, volume increases, and we've got a clump of large red bars. So these are 3 different things you can do to confirm chart patterns. In the 6B, we had a head and shoulders that was confirmed across 3 different time frames. And on the 6A, we had a Scleroux box where we expect the same price movement above a range as it happened below. Then in oil, we had our stop hunt, which predicted a move above, but also the trading volume that supported that short was the way to go. Thanks for watching. I hope you're able to use this in your own trading, and we'll see you again soon.